Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, May 14th, 2025. We begin our episode with our first headline. Dr. Copper says gold near 90-year high. I've talked a lot about gold being in a bubble on this channel, and I'm going to keep pounding the same drum and saying the same thing until proven otherwise. Longtermtrends.net has the copper to gold ratio. You can go to the website yourself and see that currently it's hard to see, but we have 0.40 zeros and then 89. It got to 0.88 in 2020 briefly, but has never been that expensive to copper since then. Since it hit there in 1980. Take a look at what happened to gold after 1980, by the way. And then since then, gold has never been this expensive to copper since 1935. So 90 years, we are basically at all-time highs in gold compared to copper. I will state right here, right now, as a matter of fact on this show, that all of the copper in the world is not worth 1 ounce of gold. You can't have this just keep going in the same direction. Either copper is severely undervalued, which may be a possibility, or more likely gold is actually in a bubble. At least that's what I see in my crystal ball. But it could be both, right? Copper should be higher a little bit, and gold maybe should be a little bit lower. We're at historic highs in gold compared to copper right now. And just to bring up one other comparison, gold to oil ratio, how many barrels of crude oil is worth 1 ounce of gold? Currently, it's worth 56 barrels of crude oil. This is an all-time high, and this chart goes back to 1946. I'm not saying that gold can't necessarily go higher, but I think that it has this is ridiculous at this point. And any reasonable person should expect some kind of reversion. Oil going up and or gold going down in price. Second headline of the day, Fed rate hike odds tick up slightly. I'm not even going to look at the Fed funds futures. All I need to look at is the 10-year break-even inflation rate along with a few more charts. I want to mention that today specifically the 10-year break-even inflation rate actually shot up today, and actually we're at this previous high that we had in March 27th, 2025, before we started this pattern of lower highs and lower lows. And so if this breaks to the upside, if this continues higher, this is no longer a lower high, lower low situation. And if it does continue higher and higher and higher, like if I said on a few shows ago, this is one of the main things the Fed uses to gauge their monetary policy. If the 10-year break-even inflation rate starts to get out of control and the market starts pricing in higher and higher inflation, they will be forced to actually raise rates. Now, it's hard for me to see that coming, but you can't take that out of the realm of possibilities. The 10-year break-even inflation rate right now, like tomorrow, is important, very important for me. If this goes even higher tomorrow than 2.39, we're definitely not in this lower high, lower low situation. And so for that reason, Fed hikes actually start, adding a little bit of probability here. Add to this that we have the 10-year minus 3-month Treasury. When this is steepening out of a inversion, every time in the past this has steepened out of inversion, it's gone straight into a recession. But all of these cases were because the Fed were slamming rates to the floor and the front end of the curve was dropping below the long end of the curve. And right now, at least just for today, this is like a very small sample size, right? I'm just talking about from yesterday until the past 3 days, let's say. We're seeing steepening here between the 10-year and 3-month Treasury, and the this is not bear steepening. Bear steepening means that rates are going down, especially the 2-year dropping below the 10-year, while the 10-year actually usually does go down with it. This is bull steepening. This is what has been happening in the last few days anyway. All of this is to emphasize that the chance of a Fed rate hike is actually ticking up slightly over yesterday, the day before, and today. Overall, markets didn't really move much. It was kind of one of these days where Mr. Market's like not sure what to do. Tomorrow we have PPI. That can move things around. And like I've been saying for a while now, the initial jobless claims and continued jobless claims are going to be really key to see, is the economy okay? Are we going back into heat up mode here? Is that really what's happening? I mean, that's sort of what the charts are saying today, but just today and yesterday. There are some interesting charts today I'll go over. Before then, community topics. What moves, if any, did you make today? Comment below. Robschild sits on his hands. Coming up, we have continuous tariff updates. Tomorrow we have PPI, another inflation gauge that sort of acts as more forward-looking than the CPI that came out actually cooler than expected. So let's see what's happening with the PPI. Then we have initial continuing jobless claims, like I just mentioned. We also have Walmart earnings and Alibaba earnings coming out before the bell tomorrow. And Walmart is one of these mega voices out there because they see what's going on with consumers more clearly than anyone. And so, yeah, Walmart they always have something interesting to say about what's going on. So we'll see what happens with that. As always, thank you for watching, subscribing, commenting, and supporting the subscription buttons over here. And this is how you support the channel. Thank you for all of your support, also in the description. No major changes in the daily reminders macro views. See my website in the description for me to explain these things. Also, no changes in the crystal ball ratings nor the Robschild portfolio. Although, if things really are heating up, I mean, I kind of chuckle a little bit because I can't believe the second headline of today. It's like, but it's happening. We are experiencing bull steepening right now. Again, just today and yesterday, but that's really the biggest headline of today. But anyway, for now, I still see this as my crystal ball ratings, and also no changes to the Robschild portfolio, although this is more like at least 55% right now. That's long duration Treasury bond exposure. I bought more zeros yesterday. Onto the charts, starting with the S&P 500, the SPX forming a doji candle today on light volume. Again, this is just a telltale sign that Mr. Market really doesn't know what to do up here. Maybe he's looking around trying to figure out how he got up here in the first place. I'm not sure. And while the price of the S&P 500 went higher, the advanced decline line actually ticked down. That's not a confirmation of bullishness. In fact, quite the opposite. This can signal a reversal to the downside in stocks. TLT, my favorite place to be. If I was a little more patient and paid more attention to the chart pattern, I would have bought today instead of yesterday. Get a little bit of a discount. I mean, it's just so funny when I draw lines and Mr. Market. You can't even see it here, but Mr. Market closes right on my line. Swear I didn't move this. It was here before. This was my gap fill zone that I said we need to fight in. We are fighting in this zone now. I said I would load up on TLT, and I have. I have almost no cash now. I'll put all of my current available cash into ZROZ. I said yesterday that I saw a divergence in the RSI and how that could signal that this was a bottom here with this little yellow line here, but that's no longer the case. We have slightly down on the RSI compared to that candle now. However, moving further back, I don't know how much of this we can count necessarily, but we do have a higher high compared to the low that we had on April 10th, which was this low right here. So we have a way lower low in the price from that date and a slight higher low in the RSI, which I think can count as a divergence. Plus, this being the gap fill zone, I imagine there's going to be a lot of buyers coming in right here, but just a guess. If initial jobless claims drops and continued jobless claims drops and tomorrow, along with PPI just exploding higher, everyone's paying more for stuff all of a sudden, then yeah, TLT can drop lower from here. Do I think it'll happen? No, but we'll see. I can't tell the data what to do. The data has to tell me what to do. So see what happens tomorrow with that data coming out. While longer rates are pretty extended to the upside right now. I mean, even if the initial claims and continued claims are slightly good and PPI is slightly high, that's not necessarily going to keep rates spiking to the upside. But we'll see. We'll see. This is the main thing going on today in charts that I see. Wanted to bring up gold today. Gold cooling off back to the top of this little parallel trend line here. I'm just noticing right now that we have pretty clear M pattern here, which we broke we broke the bottom, and so we could actually see from here to here play out to the downside to around this range by that little chart pattern there. I wanted to also bring up SMH, semiconductor ETF, also eking out with a doji candle. This is not a sign of strength, and we're massively overbought in the RSI. So the normal thing to do from here is to pull back pretty hard when you go straight into an overbought condition. But if it's able to stay in an overbought condition, this can, cause it to go into, gamma positive territory where, it becomes more clearly bullish. So will this spike down? I mean, this is tomorrow. The rest of the week can really determine the further direction of where we're headed. For now, spiking into overbought territory, the normal thing would be to actually drop down to some level of at least, test this giant gap that we jumped over. Maybe explore that area a little bit before deciding what to do after that. Next, IWM, the Russell 2000 Small Cap Index. This is an ETF. I've been noting, hey, if we're going to get back into bullish mode with all stocks just continuing up to the moon, we gotta at least see a higher high. As it stands, we have lower low, lower high, lower low, lower high, and we're back up to this previous high, and we still can't go above it in the Russell 2000. In fact, breaking to the downside today. This is looking more bearish than anything else. I also want to bring up the MOVE index. Sorry for the disorder of charts today, but yeah, it's more clearly on more of a sloping trajectory, sort of wanting to go sideways here. But with TLT dropping, almost 1% today, you might expect the MOVE index to start spiking. Instead, it's settling, interestingly. So I don't think people can confidently be short TLT right now. They're going to have to come out of their shorts at this level, in my opinion. While the S&P 500 and semiconductors are up, the XLV continues to drop and starting to look more and more attractive. The more that this drops, the more attractive it looks. Again, we're down 19% from the peak, while the S&P 500 is only down something like 5 or 6% now from the top. And it has lower beta. This is not supposed to move as much as the S&P 500. Being a healthcare sector, this divergence is clearly setting up a good opportunity. In fact, it's 7:45 right now p.m. I'm not going to be able to make a decision by 8 p.m. before post-market closes. But this is starting to look really juicy here. I may be taking a bite, maybe pre-market tomorrow, but I'm not sure yet. Last chart of the day, I want to bring up junk bond credit spreads again. We're back into unusually tight area here, 3.1%. So literally something called a junk bond. In other words, it has junk credit compared to a treasury. It has to pay only 3% extra on top of treasury rates right now, and people are willing to, buy these things. And we don't often get 3% or below it. You scroll out to a 10-year history, is rare that we get even to 3, only a few times. It's a lot more normal to see it at least, between 4 and 5%. At least, above 3, not basically at 3. When credit spreads get this tight, it screams complacency. But who knows? Maybe the economy is great. Everyone's doing wonderfully, and wages are about to just skyrocket. Everybody's going to get the home they want, and everything. With these rates going up, by the way, mortgage rates go up too. I don't know about you, but with the housing market being at basically an all-time high compared to median income, I'm not sure that this is going to last. But what do I know? I'm just a guy with a crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. We'll see you next time. Robschild.